everything depends. And the depends is a lot more questions and understanding of the situation. And if you're not being asked the questions to get more clarity, you're not getting good advice.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hi, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein, and I am here to give you guys advice that you can take action on each and every day. Please go back, check our other episodes. We've got over 60 episodes in the books. You could like, share, and subscribe, but we've got every topic you can think of in all things insurance, finance, and more. And today I'm being joined by my lovely producer, Allie, again. And today's episode, we're going to do some freestyle. Allie's got a bunch of questions that she's been collecting from our audience, our studio audience. Is there a studio audience? Get the crowd going. We've got some questions that were being asked. We figured we would address them on the show today, kind of a freestyle thing. So, Allie, I'm going to turn it over to you. I'm going to answer them the best I can. I have not seen scripted nor know what exactly she's going to be asking me, and hopefully I can do justice with a response that people can take action on accordingly.
Perfect. All right. So we've done a lot of stuff recently around annuities. And so I actually have a few questions there. If you haven't listened to our annuity episodes, there's two of them that were just released. I believe they're episodes 57 and 58. So go back and listen to those. And some of the questions we got, the first one is, what is the most common annuity that you sell and or that people buy?
Well, you know, I think every advisor is going to have their own forte. I don't know the statistics of the most issued or voluminous as far as dollars. I know that billions of dollars every year go into annuities, first and foremost. And if they go back and check our episodes, there's 4 types of annuities. You've got a single premium annuity, which is like annuitizing. You've got an indexed annuity, you got a fixed annuity, and you got a variable annuity. Now, a variable annuity, you need to have a securities license. So there's financial advisors out there that have a Series 6 or a Series 7, and they could offer variable annuities. And a lot of them are not fans, or their broker-dealers don't like index annuities for whatever reason. I'm sure it has something to do with grease in the palms and how much vig they make on these things and the behind-the-door deals. But I digress. And don't think it doesn't go on, because it does. I've heard and seen it myself. Indexed annuities, fixed rate annuities, insurance licensed individuals don't need a securities license. So, you kind of have some dichotomy between both camps, what one can offer versus what another can offer, why one will or won't offer. That said, a variable annuity, the client is taking on the extra risk, maybe is paying for, some living benefits, some guarantees. There's some upside and there's some downside protection based upon the guarantees, but there's a lot of hefty fees in a variable annuity. An indexed annuity can give you some upside participation in the markets, but has no downside. And so how I place and use them is based upon the risk tolerance and the assets, the percentage of the assets that my clients want protected. And then their financial advisor, their investment, whoever they're doing their investment and more aggressive work will keep the other money in those higher risk investments. But we're carving out what we want to be the protected money, so that if the stock market collapses or corrects 20, 30, 40%, not all their money is in the way. They've got money protected. So, I don't know the specifics. That's the majority of what I do. A fixed rate annuity is like a CD. I've never really did a lot of those. So when I was security licensed, I did millions and millions of dollars in variable annuities. Again, indexed annuities were not either available or allowed to be written in the brokerage industry when I was there. They wanted us to do and use variable. Now that I'm not in that space, I can't do variable, and index serves the needs I want. Again, I'm not the person that's putting a round peg in a square hole. I have nothing to sell. I just have problems to solve. So if it doesn't solve your problem, you're not going to implement with me because I'm not going to have you do it. If you and Glenn are trying to make 15% rates of return and be super aggressive, an index annuity is not for you. You're not going to make 15%. Just can't happen. Now, you can go buy tech funds and Tesla and Google and, do all kinds of other crazy strategies with your, Robinhood accounts and, TD Ameritrades if you want, or work with the mainstream broker. But it's just different risks, different rewards, and it depends on the client profile. So, your question, as most of the time I get, is general, and I always start, it depends is always a big answer I've given over my decades is, well, it's not clear cut, right? It's not like page 16 of the textbook says do this. Everything's tailored. So it depends on the client situation. It depends on the assets that they're dealing with. It depends on, what makes the most sense. Can they put 100% of their money in an index annuity? No, never. 10, 20, 30, 40%? Maybe. Yeah. So again, it just depends on what you're dealing with, the age of the client, the timelines, the use of the money, what's the back end of it. The higher return participation annuities usually require a 10-year contract, which means their money's not fully liquid for 10 years. So that has to come into the equation. Now, most annuities, folks, have a 10% free surrender every year. So even if you're in a hefty surrender timeline, I've seen annuities back in my day that had 25-year surrender charges. I've never seen clients contracts like that. We're like, oh my God, like this guy bought something in the 70s that had a 25-year surrender period. Like, who does that? Like, it doesn't I don't think they even exist anymore. But 10's the norm in most cases. And part of that is, as I've explained to clients, is it gives the annuity company, the insurance company, the longer period of time to put the money to work. Because all they're doing is using your money in a higher risk vehicle to make a spread. So if they're going to cap you at 10%, they're hoping to make more than 10%. They make 12, 13, 15. They used your money. They took a higher risk. They gave you your 10. They keep the difference. So it's, OPM, other people's money. I mean, that's the whole insurance game, isn't it? Next question. Did I answer that all right?
Yeah, that's a good segue actually into the next question.
All right.
What are the best uses for an annuity, and in what ways should you not use an annuity? For example, would you want to use that annuity to pay off debt or pay a mortgage?
So again, I'm back to it depends, right? So the depends is this. Are we in accumulation mode first, or are we in spending mode second? So where in the journey is that conversation being asked? Right. So the client that's asking that, the individual that's asking that, I basically say, well, how old are you? What stage of life are you at? And what's the intent and the purpose of that money? So if I'm 30 and I'm looking to put it away and I want the tax deferral, which is a big component of annuities, and I want a lot of risk and I want to make a lot of money and I don't want to pay tax on it and I want it to compound for the next 35 years, well, then a variable annuity might be the most aggressive play for them, right? If I'm 60, 70, 80, and I just want modest returns and I don't want to be very heavy in equities and, I'm happy making between 4 and 6 or 7 or 8%, well, then you're into the index again, or maybe a fixed annuity depending on the rates. So it just depends on circumstance, right? And then we've touched on SPIAs in the past, where they're not looking to leave $1 million in the bank. They want to utilize it, and they can annuitize that $1 million, buying a SPIA, generate lifetime income that dies with them. So again, it just depends on where and the what's. The lump sum conversation, I think the part 2, you were saying something to do with mortgages. You want to read the rest of that again?
Yeah, so part 2 of the question is, in what ways should you not use an annuity? So, for example, would you want to use your annuity to pay off debt or to pay a mortgage?
First thing we want to be aware of is the age of the client and the circumstances and the timeline. Annuities, from a tax standpoint, are quasi-retirement vehicles, meaning your IRA, your 401k, has an age 59 and a half penalty. So does an annuity. technically to distribute money, to take a withdrawal from an annuity, it's treated like a retirement asset, 59 and a half. Now, there's ways to get around younger people taking money out of their 401k and their IRA called 72T and 72Q. And so you could take money from annuities early. You could take money from 401k and IRAs early based upon that. And that we won't get into that today. So accessing the money at certain ages, going into it, if I'm 30 and I want to fund my kids' college in 18 years, annuity is not the right vehicle because I'm going to be 48 and I can't withdraw that money without penalty. So it's not a good vehicle per se for a younger person for college planning. Ergo, you would be looking at more like a 529 plan of some kind, right? Coverdell's, stuff like that. But again, you and I talked offline of like, if somebody has a mortgage, should they annuitize? You know, should they put money into an annuity to take income stream to pay the mortgage? And my response to you was what? It was like, well, why wouldn't I just pay off the mortgage? So again, circumstance, folks, circumstance. Tell me more. The questions are general. Everything depends. And the depends is a lot more questions and understanding of the situation. And if you're not being asked the questions to get more clarity, you're not getting good advice. Because if somebody's answering Allie's question universally without asking more questions, they're not really doing their job. I mean, that's the reality, Allie. That's how I would respond, is like, I need to know more information.
I am going to switch gears. So we're going to move off of annuities. And one of the other questions we have here is, can you create an income from life insurance dividends?
Oh, yeah, that's a good one. So, I mean, the simple answer is yes. And again, not that we're trying to plug the show and the other episodes, but we've got some short clips on Be Your Own Banker and Infinite Banking. And I think we've got an episode on, building your own private pension. So, the quick answer is yes. But like anything else, depends on the circumstance of what the client's trying to do and achieve. But over the years, we have successfully built private pension, life insurance driven plans for people, meaning they bought life insurance, they overfunded the contribution. So any life insurance has a minimum payment. There's a minimum amount of money they need to cover the cost of insurance. That's term insurance. Then you have accumulations, whole life, universal life, index universal life, guaranteed universal life, whatever it is, whatever the products are, you put more money in above the cost of insurance, and then it earns interest or dividends or however you want to, call it, and you accumulate the cash value. The cash value does what? Cash value alleviates the premium increases as you get older because your cost of insurance goes up. 35-year-old becomes a 45-year-old. The cost of insurance is higher. Never goes down. You're never younger or healthier than you are today. I mean, it's pretty much, tell people all the time, I'm going to wait to get my life insurance. It'll never be cheaper than it is today, Allie. Your health isn't going to be better than it is today in all likelihood, and your age is not going to be lower. So price just keeps going up. Cost of waiting has to be calculated too, right? And what if you're not insurable? So if you're using an insurance vehicle that has a cash value component, you can structure these to overfund, and you have to calculate how much you can overfund and how it works. And, you don't want to take on massive amounts of insurance, but there's calculations on how much insurance, you can abut up to and build enough cash in there to give you that flexibility. So you're overfunding the life insurance just like any other investment account. If you're using an indexed universal life product like an indexed annuity, you're getting market participation. You're getting a percentage or a cap. So it's modest in return. It's not super aggressive. And then again, just like the indexed annuity, there's no downside. There's costs because you got cost of insurance and fees, but Unlike an indexed annuity, there's no fees. But the life insurance has costs because you're paying mortality and expense fees. You're paying cost of insurance. So you have to keep the lights on for the life insurance itself. So the life insurance is the umbrella. It's the cover. And then the cash value is being grown and accumulated. So when we design these, we forecast out, modest rates of return, historical performances, 6, 7, 8%, nothing crazy. Would anything more than that would be somewhat unjust. Because you can't back it up, not with an index and product. And then what happens is certainly time is your ally. And if you go back and look at our episodes, we talk about the rule of 72 and rate of compounding. So the younger the person is, the more years the money stays in there and it compounds. So if I'm making 7%, every 10 years, that money's going to double. So I'm overfunding the life insurance. I'm putting in, 50 grand a year for the next 30 years. I'm a medical student that's starting his career, a doctor, a dentist, a lawyer, an accountant, whatever, sole entrepreneur, business owner, somebody who's not given a retirement account, a retirement plan. They need life insurance. And now they can leverage that life insurance using the accumulation of the cash value and then design for them a private pension, if you will, because they're not getting a pension. They work for themselves. And so what happens is the cash value grows and accumulates. I think we did an episode on this where we talked about surrender to basis, switch to loans. So you're basically going to pull out the equity. So if I put in, make up the number, 50 grand a year for 30 years, that's 1.5 million of basis. I'm going to pull out my basis. And then once I'm done with the basis, I then borrow. I take a loan against the remaining cash value. But how many years did I use the $1.5 million? Let's say I want 100 grand a year. I'm going to put in 50. I'm going to save for 30 years. I'm going to retire at 65. I'm going to live 25 more years to 90, right? That's the math. And I want to have $100,000 tax-free income for 25 years. We got to solve for that math. Like, will that work? Like, can that come into play? And so now that 35-year-old saves for 30 years, retires at 65. Now we're taking out 100 grand a year. We know a basis is already in there for $1.5 million. 100 grand a year is 15 years. So first 15 years, he took his own money out. The original basis comes out first. It's all tax-free. Plus, the money that was in there does what? For 15 more years, it's still growing. It's still compounding. So all the money that he accumulated is still accumulating, right? It's still compounding. He's pulling out 100,000, but there's 1.4, 1.3, 1.2, right? So now all of a sudden what would we just say, 15 years. So now he's 80. And now all that cash value, he's going to got at least 15 more years. He's going to borrow $100,000 a year, which is a tax-free revenue stream to him. And eventually, whatever's left over in the policy is going to get paid to his heirs. And so the math is just calculated to design this for somebody and utilize the tax efficiency. Again, we're repeating some of our previous episodes, LIFO, FIFO, the tax treatments. If you did this with an annuity, you get the same tax deferral. You don't have the cost of insurance, but you can't FIFO your annuity. Annuities are LIFO, last in, first out. So all the interest is taxable. You can't surrender the basis. You can't borrow money against annuity. So the life insurance is a way to do that. That makes sense?
Yeah, that makes sense. All right, we got one question left. So this question is, where'd it go? Excuse me.
I'm gonna date myself. Is it from a Mr. Richard Fader from Fort Lee, New Jersey?
No.
Do you even know what that is?
No, but the first thing that came to mind was Sleepless in Seattle. Where they also had similar people calling in, and they would have names and fun things attached to them, like "This is Sleepless in Seattle" and calling about ABC thing. So
my reference goes back to Saturday Night Live and Gilda Radner, the late great Gilda Radner, and so she used to come on. She used to do the when they did the evening news section of Saturday Night Live, and she come on there. She was Rosanna Dana Dana. I'm Rosanna Dana Dana. And Mr. Richard Fader from Fort Lee, New Jersey, writes in and asks, and then he has some silly question, and she goes on some rant. So I'm dating myself. So hopefully my older friends who are listening to the show can remember in fond memory Rosanna Dana Dana. Rosanna Dana, whatever it was. Gilda Radner. Anyway, go ahead. I'm sorry.
So, does it make sense to convert a term to whole life insurance? And when would that make sense to do?
So does it make sense? So converting to term. So first and foremost, not all term policies are convertible. So you definitely want to make sure when you're looking at your term policies that if conversion is something you'd be contemplating, you want to make sure your term policies have that feature. That's first. Second, you should know when that conversion feature ends, because they don't always coincide with the extinguishment of the policy. Meaning you got a 20-year term policy, but the conversion feature expires in 10 years or 15 years, not necessarily 20. So you may not be able to have the decision all the way at the end of the term that you picked, and you'd have to make a decision sooner. So those are a couple of the heads ups there. What your decision making is comes down to whether or not you need or want to continue having life insurance at that point of your life. So if you bought a 20-year policy and the 20 years is winding down, you were 35, now you're 55. Do you still need the life insurance? That's A. B, you've determined you do. Well, how much is it to convert? That's B. C, am I still insurable? What if I got a new policy and would it be cheaper? So you'd want to do that homework before deciding to convert. And if the person is healthy and insurable, all likelihood they're going to get a new policy much less expensive than converting. But if the person's not insurable, they've had a heart issue, cancer issue, whatever, they've just got things now that are going to keep them from being approved for new life insurance. Look, you can get turned down for you can get declined on a life insurance application for filing bankruptcy, because there's a high suicide rate with financial distress tied to bankruptcy, and some insurance companies will not issue a new life insurance policy to somebody who filed for bankruptcy within maybe 2 to 5 years. So your health is fine, but your financial health wasn't. You filed bankruptcy and now you can't get a new policy for 2 more years, and your policy is going to expire. Now you got to convert it and pay whatever the piper is. But conversions are high. They're expensive. Part of which is they got you, right? You're captive to them now. You can't get it somewhere else. So that's built into the price and they know it. But you're, in theory, 20 years older and they don't know what they're buying. What if God forbid, what if my policy's ending on March 1st and I just got diagnosed with terminal cancer, and in a month my policy was going to expire? You think I want to convert that son of a gun? 6 ways to Sunday? Sure, because in a couple months I could be dead. I can't get new insurance. I don't want to lose this insurance in a month. I better convert it. $15,000. Okay. Like, who's going to balk? I'm going to be dead in 2 months. Like, it's guaranteed. It's good. The 15 grand's coming back. So again, it depends on the severity of the situation, depends on what's going on. But as anything else, I would look at my options to see if I can qualify for a new coverage. My wife, Robin, and I we redid our own policies over the last couple of years. We had 20-year term that a few years ago, the 20 years came up, and now we're getting, a price, not to convert it, but to continue it. And the price was like 10x. I was paying $500 a year for her and it was $4,000. I'm like, I'm not spending $4,000. It was 8 times what we were paying. But now she's 55 instead of 35, right? Or, whatever it was at the time. So we went out and we filled out an application and she went through underwriting and we got her twice the coverage for less than half of what that $4,000 quote was. So I got a brand new policy locked in for less than half of what the continuation price was going to be. And I got twice as much coverage. Now, she was insurable. And I did the same, relatively the same for mine when mine came due. So conversion, I don't have a ton of cases that I could tell you where I've converted. I do have one in the works that's got a few more months. My client, Abe, is probably not going to be able to get a new policy due to his health. And I put him in term 20 years ago and he, whatever it was, 18 years ago. And he's like, hey, this is coming due. And I'm like, well, let's shop you. Let's see if we can get you a new policy. And he wasn't approved. So I said, all right, well, we circled the date. We're like, you have till this day. So keep your term until this day and then we'll convert it because he's got no option and he wants it. So he's going to pay it and eventually we'll convert it. Right. So I could probably tell you that's the one and only case that I've ever had a conversion. Most of the time they either wither away, or we replace it. We just get them a new policy. So it's, you make it long enough in the business that all the clients you did 20 years ago, their policies are coming up. I get to redo all the business now. It's pretty good. I just did one of my college roommates. He's like, I still need something. I'm like, all right, what do you want? So we got him like a 10-year term for, like $50 a month, like just to get him to the hurdle, right? Just to get him a few more years out and make sure his wife's covered and, remnants of a mortgage and 4 kids' weddings and, the like. So, everybody's got needs. It just depends. You tell me the problems. What do I say to you all the time, Allie? I got nothing to sell. I just got problems to solve. So tell me the problems and we'll try and figure out and dissect, some solutions, give them some ideas. And that's what it's all about, folks. It's being proactive. What's the emphasis of the show? I talk about all the time. It's proactivity. Education, understanding, knowledge is power. The more I know, the more I can help you make the best decisions with what we know is out there. If it's too ambiguous and too vague, the advice is just not going to be rock solid, then, you're destined to fail, right? In most cases. So we're hitting the half hour. You want to stop here? Or you got any more questions?
No, that's the question I got for you. A good time to,
all right. Well, hopefully people like the freestyle, Allie. What do you think? Would it have some good flow?
I loved this. I thought this was great. And if anybody has any questions, send them on over.
Keep the questions coming in. So, all right. So we were freestyling here with my great producer, Allie. So thank you, Allie, for joining me today. Folks, please like, share, subscribe. Come to asktheplanman.com, planman.tv. Bruce at asktheplanman.com is my email, 844-PLANMAN. Just hit that like, share, and subscribe button. Keep coming back. As always, we want to hear from you. Today's episode was more freestyling with some of the questions where we have been receiving. So thank you to those who sent them in. Keep them coming. If you need some advice, always get it right. Come Ask the Planman. I'm your host, Bruce Weinstein. Until next time, Allie, thank you for joining us. And we'll see you next time, everybody.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.